Doug, welcome. Why don't we start there? Let's say you're lucky enough to have had some of these winners, whether it's the QQQs or Bitcoin or the individual shares in NVIDIA. And now they've become too big a portion of your portfolio. How do you sensibly reduce that?
Yeah, so we talk about concentration risk, right? When one particular issue or position starts to become too heavy in your portfolio. What I like to do with my clients is figure out a threshold, like 10 or 20% of your overall investable net worth, that you're really comfortable holding a particular position in. For me, it's around 20. I don't like seeing more than 20% of that one thing, unless it's your personal
So you could
residence.
have 20% in a single stock?
Well, you have to keep in mind that if it's such a winner, you have tax consequences associated with really paring that down. So you want to be really conscientious about what the tax ramifications are of paring something down. What if it's 40, 50% of your portfolio, and then you're going to pare that down 30%? That's pretty significant. So it's personal, it's individual, 20% for some, 10% for others, but you want to
have
pick
a
that target.
threshold in mind.
Yes.
And is the way to reduce that position to do sort of the opposite of dollar cost averaging, to sell a certain amount at a regular interval so that you're not selling at what turns out to be an intermediate trough?
Absolutely. You can reverse that age-old strategy of dollar cost averaging and start to exit on a periodic basis, whether that's over a shorter term period like 3 months or over the course of a year. You want to keep your time horizon in mind.
Let's talk a little bit about a big cluster of your clientele, and that is the people we call the Millennials. I'm a baby boomer.
Yeah.
I hate the Millennials. No, I don't really hate the Millennials. What is different about them as investors from previous generations or from generations that are following behind them?
Yeah, I think they have a very interesting experience kind of embarking, if you're talking older millennials, embarking into the world during the Great Recession. They have kids and they're hit with a pandemic. So there's actually a lot of caution, I feel, with this generation. They're really looking around the corner, looking over their shoulder a little bit. That might make them a little bit more conservative. Now, they do recognize that if they have a lot of time on their hands, 20, 30-year investment period, they do need to be invested in equities, but we see larger cash reserves. We see an appreciation.
So they're more conservative. That's out of experience.
That's out of their learned experience and having gone through some pretty interesting things over the last 10, 15 years. And I see it a lot really with cash. They really love having larger emergency funds than other cohorts because they've been hit with those very disruptive events throughout very pivotal times in their lives.
Is this a bad thing? Do you advise them? How do you advise them?
Absolutely. Too much cash can be a bad thing, particularly when you're young. You're missing out on the opportunity to invest. So you're scooping up, 5% on your risk-free money here? Good. You got 2.5% halfway through the year. S&P 500's up 14%. You missed the boat there. So if you were over-allocated, you really didn't do yourself any favors. But when it comes to protecting yourself, look, 3 to 6 months living expenses in cash, that's rule of thumb. I like seeing 6 to 9 months, maybe up to a year for your more, protective people, but no more than that.
Too much cash is a bad thing, I heard you just say. I can't imagine that too much cash would ever be a bad thing. Are the millennials more purpose-driven in their investing?
They can be, right? They're looking to invest in companies that have missions that maybe benefit more than just the bottom line. And you're seeing that, classic companies like Warby Parker and other companies that actually have a big give back component to them. That's become more and more popular from founders of companies these days.